Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Matt Bartolini, Head of Spider Americas Research at State Street Global Advisors. We're talking about the market outlook and investing strategies for the second half of 2024. Matt, welcome back. Great to have you with us today.
Yeah, thanks for having me back. Excited to talk about the rest of 2024 and what we've seen so far.
Sure. So the question of whether the US economy will be able to achieve a soft landing has been the biggest concern for investors for the past year or so. And the recession that many economists, experts were predicting, that has just refused to show up so far. And in fact, many investors have just remained on the sidelines, waiting to deploy capital only if the Fed manages to engineer a soft landing. And the note that you published last week, I saw that the note says that the long anticipated economic soft landing has already transpired. So tell us why most investors likely miss that soft landing.
Yeah, I think we have had that soft landing. There hasn't been the full mission accomplished type of data report or Fed actually cutting rates, but the Fed has been able to really thread the needle here and ensure that overall growth continues to remain positive. The labor market continues to remain resilient, and their battle is yet to be won on inflation, although they have made progress. So I think that a lot of the concerns heading into the year was that the Fed would have to cut rates aggressively in the fact that growth would start to really disappoint. And while we do have sort of below overall historical average GDP growth, it still continues to remain positive. The consumer continues to remain strong. And overall, the labor markets continue to remain quite robust. Even just this most recent labor report, where you saw a significant number of jobs were added. But I think heading into the year, there was a concern that the Fed would have to cut rates because of either massive slowdown or even this idea of recessionary type of spirits, because a lot of the leading economic indicators and the yield curve being inverted, those type of sort of traditional measures of when a recession might be on the horizon were still signaling some weakness. And I think those traditional metrics are really being put to the test for what we now have from a new economic reality where labor markets and the consumer have changed from a socioeconomic perspective post-pandemic, where basically growth is being formulated out of different areas, and it's a little bit harder to measure now. And I think that's what we've seen so far this year. And for the investors that were seeking to allocate capital and put risk to work and were not so concerned, there have been some pretty strong returns from global equities, not so much in the bond space, but equity markets, risk assets have responded favorably.
So yes, the economy has been remarkably resilient so far. Do you see any near-term recession risk, or do you expect this economic resilience to continue for the rest of the year as well?
So our base case is that, is not for a recession. I don't think that is in the cards in any event, unless there's some sort of idiosyncratic exogenous event that takes place. I think where we are now, you still see healthy growth formation. You see manufacturing start to improve across the globe, which is then helpful and conducive for the U.S. And you continue to see really strong labor markets. I do know, it is noteworthy to see the unemployment rate tick up to 4%. That's sort of a very psychological barrier, but you still see really healthy job reports. And so I think we're going to be in a sort of, early to mid cycle sort of oscillating type of mentality for, the next couple of months and into 2025, where growth is not eye-poppingly large, but it is healthy and it is substantial for a functioning economy where it will keep labor markets behaved, and we're not going to see massive spikes in unemployment where you then would lead to economic malaise. So I think we're in a good shape.
Excellent. So the biggest question for investors right now is whether at all and how much the Fed will cut interest rates in the coming months. At the beginning of this year, the market was pricing in about 6 rate cuts. And now we are wondering whether there would be a rate cut at all this year or not. And in fact, the central bank is meeting this week, and they are expected to leave interest rates unchanged at this meeting. And we have seen that the market now continues to scale back bets on cutting rates this year. So what do you think of interest rate path for the rest of this year?
I think in this world, there are sort of 3 certainties: death, taxes, and Federal Reserve policy uncertainty. And I think that's the type of market we've been in. And I think that's why you see in the rates market, in the fixed income space, bond volatility being significantly elevated. I mean, we're in an anomalous state of bond volatility. Long-term treasuries on a rolling 90-day basis have a higher standard deviation of returns than the S&P 500. Typically, long-term treasuries, the perceived safe haven that everyone rushes to, has a standard deviation of returns that is 4 percentage points below that of equities. Right now, it is above that. If you look at rolling 90-day volatility on the ag, it's in the 90th percentile historically. We are in a very, very elevated period of bond volatility because monetary policy continues to be evolving, and the Fed is anchored in on this idea of data dependency. The problem is the data has been variable. We're seeing bigger upside and downside surprises to CPI than we've seen in the pre-pandemic average. Similarly with jobs reports, that was evidenced just in last week where it was a massive upside surprise. So we are continuing to evolve in a monetary policy landscape where there's this constant stream of repricing of rate expectations. So I think where we will net out is, in perhaps the first cut comes in the fall, but the problem there is the window is getting narrower. The window is closing where the Fed can affect monetary policy without an exogenous event like the U.S. election. And I think it's really just interesting. It's such a calendar quirk or conundrum, and it's just going to only stoke more volatility, is that the Fed meets the day after the election. So talk about a massive amount of uncertainty. If this plays out like it played out in 2020, where we had no idea who won, who was winning, losing, how many votes were left to be counted, and the Fed now has to go and deal with all of that and affect monetary policy, that's a hard job. And what's even a harder job is to predict what they might do, because I don't even think they know what to do. If you look at their dot plots, they've moved all around. So what I would say is, rather than predicting what the Fed might do, sort of realizing that this evolution of policy only is going to stoke more volatility. So structure your portfolios not for Fed actions, but for Fed actions that create volatility. So that's how I would think about this type of market environment.
Very interesting. So despite all these gloom and doom predictions that we saw earlier this year, stocks have continued to rise, as you mentioned. And in fact, the S&P 500 and the NASDAQ, both the major indexes, posted their 25th and 13th closing records of 2024, respectively, last week. Do you expect the stock market rally to continue?
I think one of the engines that have been fueling the stock market rally has been tech, and there is a lot of strength in this tech momentum because it's backed by underlying fundamentals. If you were to remove big tech from the S&P 500, the earnings per share growth in this past quarter on a year-over-year basis would have been negative. And if we look out on the horizon, there is still going to be a meaningful contributor to the S&P 500 overall growth profile. So they're going to still stick around. I think for me, what is signaling further expansion in this rally is that growth is likely to broaden out in the Q3, Q4 numbers, as well as into 2025, meaning that stocks outside of the top 10 are now going to have a higher contribution or forecasted contribution of return of overall earnings for the S&P 500 in the coming quarters than they have had now. So that broadening of growth, to me, signals that there's more to run in this rally, and particularly in some of those segments of the marketplace, there could be more attractive valuations. I also think overseas markets are likely to continue to sort of add to the overall global equity market rally, because I do find it very interesting that, a lot of people are sort of looking at the European market. Obviously, they've been making some headlines over the last few days with election-related volatility. But on a year-to-date basis, the underlying stocks, again, up until a couple of days ago, were basically up the exact same amount as the S&P 500. So if you look at the Euro Stoxx 50 index in euro terms, right? So I'm getting rid of the whole currency translation. The the Euro Stoxx 50 index was up 14.2% through year to date through June 5th versus the S&P 500, which is up 13%. So there's actually some really strong performance outside the US, and it's coming with stronger valuations. So coupled with all of the broadening of growth and some economic rebound in particularly Europe, I think there's some potential tailwinds for further equity market rallying across the globe.
Great. So in your note, you talk about three investing themes. The first one is diversify beyond mega cap stocks. And then you have optimize income with short-term core and credit. And the third one is positioning for macro volatility with real assets. And you mentioned this rally has been driven mainly by mega cap tech stocks. And this is the trend that we have seen this year, not only this year, but over the past 5-10 years, that the big just keep getting bigger. So why not just continue to ride them? Why do you recommend equal weighted exposure to tech?
I mean, part of it is that concentration does create somewhat of an overall risk. And when we're looking at the broad-based equity markets, this massive level of concentration has impacted your regional diversification. It's impacted your overall sectoral diversification, style, everything, you name it. So I think there's still a case, though, because of the growth profile, to own broad-based tech. I think there's potentially a better way to mitigate some of the concentration of it. And that's why owning equal weighted tech that expands beyond the monolithic GICS-based tech sector, which is all fine in and of itself. But if you're thinking about this revolution in AI, having more of perhaps a global view of it as well, to bring in some companies overseas can be helpful. And what we look at is when you do an equal weighted tech version of, again, tech related and tech sectors within communication services, we do see growth being higher and above that of the traditional tech sector and the S&P 500 in the coming quarters. So it allows you to sort of play this revolutionary theme of AI and increased AI spending, but in a manner that is more properly diversified from a single security perspective, but also maybe in some of the sub-industries as well.
Very interesting. So you also recommend small cap stocks. We have seen that small cap stocks have underperformed their larger cap counterparts for many years now, and that trend has continued this year as well. And they look very attractively valued now. And I checked today, and it looks that the companies in the S&P 600 small cap index are currently trading at 14.4 times forward earnings, whereas for the large cap S&P 500 index, the multiple is 22.9 now. So why do you expect small cap stocks to outperform later this year? Because we know that many large cap companies, particularly these mega cap companies, have huge cash piles. And on the other hand, small cap companies have a greater debt burden, and most of their debt is at floating rates. But obviously, if interest rates top out and the Fed starts cutting rates, that would help small cap stocks, small capitalization companies. So tell us about some of the reasons that you believe will help smaller companies.
Well, I think it's about just diversifying your range of outcomes, because those range of outcomes are wide. As I mentioned earlier, that Federal Reserve monetary policy uncertainty extends beyond bonds. It manifests itself within equities too, based on some that are more rate sensitive, like you mentioned with small caps. So if the Fed does actually finally thread the needle and finally stick the landing with that rate cut, which I think that would then signal that sort of mission accomplished on the soft landing, while still having GDP growth being positive. Maybe inflation comes down, that gives them the room to cut rates. That could be a beneficiary to small caps because of that debt load, but also what it signals in terms of easing off of this restrictive policy stance. And now you have had, because of the rise in rates recently, earnings per share estimates for small caps being revised lower over the past months to a more realistic, achievable level, to basically mid to high single digits. And that more realistic growth is coming with really attractive valuations. So if you have a potential viewpoint of around that, look, the Fed will stick the landing, soft landing. Growth is continuing to be positive and moving higher, but rates are going to be going lower because the Fed does not need to be so restrictive. You can make the argument that these mid-cycle expansion type assets like small caps can achieve their growth profile. At the same time, you're buying into them at one of the largest discounts in relative history. So that's another way to sort of diversify the overall portfolio, because many portfolios right now are supremely overweight large cap stocks. And like I said earlier, we're talking about tech. That has impacted your sectoral diversification, your style, your size, and your regional diversification. So this is one way to sort of diversify beyond that and maybe position for an asset that could potentially do well if the Fed ultimately is 100% accomplished in their soft landing objective.
Now, let's talk about the second theme, optimize income with short-term core and credit. And this is for the fixed income sleeve of the portfolio. Your note recommends short-term active core strategies and balancing that with high-quality intermediate investment grade bonds. And you also recommend allocation to floating rate loan strategies. Please explain.
So it all just comes back to what we were talking about earlier with the Fed. Bond volatility is elevated, and it's been a rough ride for bond investors. And bond volatility being elevated at a time where the yield curve remains inverted means that taking on significant amount of duration in the long end of the curve is not really that beneficial. And we really like the idea of trying to mitigate that level of volatility by owning some of the bonds in the shorter end of the spectrum, particularly actively, where you can blend different credit and interest rate related sectors to create a more diversified return stream, but still maintain an elevated yield and seek those relative value opportunities. So we like those short-term core actively managed strategies we have in our lineup, some of them from Double Line, but also within a specific asset class like senior loans. So our actively managed senior loan portfolio from Blackstone, I think, is one way to sort of mitigate rate volatility, because senior loans are floating rate securities that reset on a quarterly basis, but it's still not sort of restrain your income potential because you're in a below investment grade market like senior loans. So you can get yields upwards of 9%. And your standard deviation of returns, because you're not taking on such significant rate volatility because you reset quarterly, is in 1% to 2% right now over the past year. So you're able to really optimize your income per unit of volatility from that perspective. At the same time, stepping into what is really some healthy or conducive credit market trends. I mean, I understand that spreads are tight right now. However, we've done the research, and what current spread levels right now, which is in quintile 1 on a historical basis, still indicate positive historically subsequent 12-month returns. So spreads being tight are not overall that concerning. However, the positives in credit are actually quite noteworthy. You have positive earnings per share growth for 3 consecutive quarters. You have an expanding economy. Ratings momentum is there, where you've had more upgrades relative to downgrades in sort of the credit rating space. And then you still have a really attractive carry in that 9% yield to give you some form of return in cash flow. So that's why we like those credit markets. We like the credit markets that are not taking on significant duration risks, because that long end of the curve is not really, you're not really being compensated to take on that much duration or volatility right now.
Those are some interesting ideas. Now, you mentioned about bond volatility and bonds not providing the same diversification benefits to equities that they were doing in the prior decades. And particularly in this environment of rising interest rates and sticky inflation, or high interest rates and sticky inflation, we have seen that long-term government bonds, which were earlier seen as a safe haven, they have underperformed, they have lost value. So you recommend that investors should readjust their mix of assets, and you recommend including some real assets, including gold and some other inflation-sensitive assets. Please talk to us about this.
So I would say, largely speaking, most portfolios are probably overweight growth equities and nominal bonds. And if inflation remains stubborn, those areas are unlikely to prove really attractive real returns. And I get that inflation has been elevated and growth equities have done quite well, but now you're overweight them likely from your historical perspective. So that's like just a more strategic view of the world right now, where, folks should probably think about real asset inclusion in their portfolio, because they're probably overweight things that historically don't do well on a long-term basis if inflation remains sticky. So that's more strategic. More tactically is that we have a fourth quarter in Q3 and towards the end of it that is going to be met with a significant amount of macro volatility, whether it's the US election or ongoing conflicts around the world. You're going to have these events that are likely to stoke broad-based macro noise, macro volatility. And in some of those, that could have an increase in some of the commodity risk premium too, just given what we know in terms of tariff protections that will raise prices, as well as, again, those conflicts in commodity-rich regions. So we think owning some real assets can help portfolios sort of owning something that can zag when the market zigs, I think could be beneficial, because we are likely to encounter some macro-related volatility. And that's why I like things like gold or broad-based real asset sector strategies, or even just natural resource equities.
Excellent stuff as always, Matt. We'll have to leave it there, but thank you so much for joining us today and for sharing your excellent insights.
Yeah, thank you.
That was Matt Bartolini of State Street. Now let's talk about some ETFs to implement those ideas. If you want to own an equal weighted technology ETF, State Street offers an excellent one. The ticker symbol is XNTK. This provides equal weighted exposure to 35 leading US listed technology related companies. And I'm looking at the portfolio right now. So you will get exposure to companies like NVIDIA, Micron, Taiwan Semi, Qualcomm, Applied Material, and all other technology companies as well. These are among the top holdings currently because of their performance, but at rebalancing, they will all get equal weights. The ETF has about 800 million in assets and charges an expense ratio of 35 basis points. Another ETF which provides equal weighted exposure to tech-related stocks is QQQE, QQQ and then E, and this equally weights stocks in the NASDAQ 100, which is a technology-heavy index. And this product also comes with the same expense ratio of 35 basis points, and this has about 1.2 billion in assets. And for small cap exposure, State Street offers the lowest cost ETF, which provides broad exposure to the small cap space. The ETF is SBSM. And this charge is just 3 basis points and has about 10.4 billion in assets. The biggest ETF in the space is by iShares. iShares Core S&P Small Cap ETF, the ticker symbol IJR. And that has an expense ratio of 6 basis points and has about 79 billion in assets. And if you want exposure to gold, GLD is the most popular ETF. And that is favored by traders because of its excellent liquidity. But if you want to own gold in your portfolio for longer term, one of the best ETFs is again by State Street. The ticker symbol is GLDM, Spider Gold Mini Shares Trust, and this has an expense ratio of just 10 basis points. If you want to look at actively managed floating rate or short-term core strategies, then you can look at SRLN or S.STOT. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast, and make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.